Good evening, all the joinees. Thank you so much for joining in. Hi, this is Prajakta. I would like to warmly welcome you all on behalf of NGEN Research. So, meanwhile others join, we will introduce our topic for today. Today, we are going to discuss on risk parameters, various risk parameters for analyzing mutual funds, right? Wherein we will have a look at value at risk, which is VAR, capture ratios, wherein we will discuss up capture and down capture both, risk versus return scatter plot, which is available on the compare section on NGEN Markets, wherein we will be able to plot all the funds that we have really taken and measure their risk and return statistics. After that, we will move ahead and understand the drawdowns analysis and what is the use case of the drawdowns analysis. Typically, when you are comparing mutual fund drawdowns with, let's say, a benchmark drawdowns, and of course, on a portfolio level as well. After that, we'll understand rolling returns analysis and, of course, rolling volatility analysis. Towards the end, we will throw the forum open for a Q&A session wherein you can get your questions answered by either typing it in the chat box or directly unmuting yourself to speak. So let us now begin. So typically today will be first coming on to the funds section, wherein we will just choose a category of mutual funds to really have a look at various risk parameters. So in this case today, we are going to choose FlexiCap as a category. So I simply click on FlexiCap, I click on close. All the FlexiCap funds really get loaded. And before that, what I've done is I've set in a AUM parameter, right? So I've taken 2,000 crore as my minimum AUM. So I want only those funds who have a AUM which is above this level that I've set. After that, I've put in minimum age is 5. So now I do not have younger funds, which are typically less than 5 years old, right? So I have only those funds who are 5 years or older, right? Once this is done, what you can then see is the next parameter, that the first parameter that we will be considering when we are discussing risk of these particular funds is the value at risk parameter, which typically will be here anointed as minimum 95% VAR. Okay, so the abbreviation of VAR is value at risk. To understand this in a little bit more depth, let us load in one particular fund and we've loaded it in a new tab. Okay, the moment it gets loaded, the first thing that we can typically do is change in the start date. So let's consider 5 years as a time period and let the analytics load. Once this is through, value at risk as a parameter can be located here. Now, what this means, okay, the value that is invested in this particular fund that is at risk. At risk of what? At risk of losing, right? So the significance of 95% here is the confidence interval with which we are putting across this data, right? So we can say that with a 95% confidence, I can say that if history were to repeat, the worst, or the drawdown, typically the loss size of this particular fund would be negative 28.73. On the other hand, the benchmarks loss would be around negative 25.79. Right. So in other words, how we can understand this is like a downside risk. This is a measure that indicates the downside risk of a particular fund versus to that of the benchmark. Okay, so if I were to say that, okay, if 100 rupees is invested simultaneously in this fund as well as the benchmark, my benchmark would typically take my capital away. Rather, there will be a capital erosion to an extent of rupees 25. Right, that means my 75 rupees would be my capital that will be staying intact. Right. On the other hand, if those same 100 rupees I invest in this particular fund, which is in this case Quant FlexiCap, it says that, okay, 28 rupees would be my capital that would really go away, right? There will be capital erosion. The capital that will stay intact is about 72 rupees, right? So lower the value at risk, typically the better is the downside risk protection that is really available with the fund, right? So this parameter that you can see, value at risk, can be used to determine that. Now, there are two value at risk that you can see when you load in a fund analytics as well as a portfolio analytics. I'll explain the difference between the both. The interpretation logic remains the same, whether it is historical value at risk or it is the implied value at risk. So implied value at risk is also going to mean the same thing, that what is the downside risk of this particular fund against that of the benchmark. The difference is in the calculation, right? Historical value at risk takes into consideration annual returns, or rather historical returns, as the baseline to come up with these numbers, which are negative return numbers, right? Negative 28 and negative 25. On the other hand, implied value at risk takes into consideration the volatility numbers of this fund as well as the benchmark. So by volatility, I mean the standard deviation numbers of this particular fund as well as the benchmark to arrive at these percentages that you can see on the right hand side, right? So typically, you will never see that if historical value at risk gives you a result that, okay, the fund has a more downside risk as compared to the benchmark, implied value at risk will also give you the same interpretation. The numbers could be different. So even if you consider implied value at risk, it still says that, okay, benchmark can go down by negative 29. On the other hand, the fund can go by can typically go down by a negative 31. So definitely the fund is riskier as compared to the benchmark, and that exactly is the same interpretation we arrived at when we were discussing historical value at risk. The only difference is between the calculation methodology that is already adopted while calculating these numbers. Okay, so that is for value at risk. Now this was for a single fund analytics. You can typically put in this value at risk as a number to actually sort funds on that basis. So let's say the cap that you want to restrict this value at risk number at is, let's say, a negative 25 or maybe a negative 28. You put in negative 28 here and you click on apply. The moment you do that, you can see that we previously had about 11 odd funds, and they have again further gotten restricted to about 6 or 7 odd funds, right? On the basis of this particular number. So now I simply, scroll using the scroller, and I can see that the value at risk number for these funds is well within the cap that we have really put in, right? Negative 28. So I want only those funds whose value at risk historical is negative 28 or low, or typically lower, right? So negative 18 is the best in this term. So Parak Parik goes down the least. On the other hand, the highest is for this fund, right? That's Bandhan for Flexi Cap fund. So this is how you interpret value at risk number. After that, we'll move on to understand the capture ratios. Again, capture ratios, in order to understand a little bit of more depth, we'll just load in a single fund and we'll have a look at that. Okay, again, we have loaded in Flexi Cap, and the up capture ratio and the down capture ratio are light here. Okay, please note the year, rather the period that we have really put in is from 4th of December 2018, right? Now, if we were to consider every single month from December 2018, and we were to compare only those months when the benchmark, in this case, which is Nifty 500, if we consider every single month that the benchmark was in a bull run, right? Rather, it gave in positive returns month on month. How does your fund match up with those positive numbers of the benchmark? That is typically what is really communicated by the up capture ratio, right? The moment you click on this eye icon alongside up capture ratio, it will throw up a table, right? It will have month on month performance of the fund as well as the benchmark, right? So fund in this case is asset, right? Month on month, it will have only those months. So as you can see, after December 2018, we directly have March 2019. Why is that so? Because we are now going to capture in up capture ratio only those months when the benchmark gave in positive returns, right? Irrespective of the fact whether the portfolio or this fund gave a negative return or not, that is not our concern here. We are just concerned that the benchmark gave in positive returns, and that is why we call it as a bull run, right? So in this case, if we consider in April 2019, right, when the benchmark gave in slightly positive returns at 0.04% positive, the portfolio or the fund went down by 1.57. Right? So it typically went in opposite direction. On the other hand, if you typically scroll down and let's consider this April 2021 as a month, right? The benchmark went up by a 0.58. On the other hand, the fund went up by 7.14%, right? That's definitely a good thing that this fund has really managed to do in the month of April 2021. Now, if we were to cumulate all of this up, all the all the uptrends month on month, that comes to a benchmark cumulative positive return when the benchmark was in bull run was 63.26. On the other hand, the fund went up by 76.56. Now, if you take a simple ratio, so 76.56 divided by a 63.26, that comes to a figure that is more than 100. And that is typically the reason that this up capture ratio is more than 100. That exactly is 121.04. Now, if a fund really exists, which is actually able to outperform the benchmark when it is in a bull run, that's definitely a good thing about the fund, right? And that is why we say that higher the up capture ratio, how much higher? Higher than 100, the better it is for the fund's performance when the benchmark is in a bull run. And that is exactly what we can see in this up capture ratio, which is more than 100. Exact opposite is the understanding of the logic of down capture ratio. It tells you how resilient, or rather how much does the fund fall by when the benchmark is typically in a bear run. Now, why do we say this as a bear run? Because month on month, we have considered only those months when the benchmark gave a negative return, right? You will never see a figure, or rather you will never see a month for benchmark which has a positive return here, right? Because that's the simple reason is a down capture ratio, right? So in this case, in January 2019, for example, the benchmark fell down, or rather went down by a negative 1.78. On the other hand, the fund went down by a 2.52. So almost double. But if you simply take a cumulative addition of all of this, that comes to the fund falling by a 29.58%. On the other hand, the benchmark falling by a negative 35.78. Take a simple ratio of that. So 29.58 divided by a 35.78, that comes to 82.67, which is our down capture ratio. It tells you how resilient is a fund when the markets are volatile, typically falling. Now, these same things, basically the value at risk and the up and the down capture ratios, can be replicated, or rather seen, for a portfolio performance as well. This was, of course, a single fund performance. So you can see these same statistics, or with the same logic, it can also be seen in a portfolio section. So let's go to the portfolio section quickly, and let's load in any particular portfolio. The logic remains the same. The interpretation remains the same. The only change is now we are discussing this on a portfolio level. So from 2018, if we consider month on month, our portfolio went up 44% when the benchmark went up 54%. So that's definitely a lower up capture ratio, and that's the reason you see it less than 100, right? Logic remains the same. This was about the up and the down capture ratios. Now let us understand risk versus return scatter plot, which is there in the compare section. For that, let's go to the compare section first, and let's load in, let's say, a list of flexi cap funds. So I've just saved in a list. These are 12 flexi cap funds that we have really loading in the compare section. Once these are here, before going typically in the risk versus return, let's add in a benchmark. So these are flexi caps. So let me add in Nifty 500 here. So I'm adding Nifty 500. Okay. Now, once this is here, we then go to risk versus return. Let's first understand what this window is all about. What all data points does this really display? So first of all, you will see this is like a scatter plot, right? On the x-axis, we have standard deviation, which is to say the risk of each of these funds, right? On the y-axis, we have annualized returns in percentage terms, of course, right? And the entire scatter plot is divided into 4 different quadrants. What are those 4 quadrants? So the first is low risk, high return. Second is low risk, low return. Third is high risk, low return. And fourth is high risk and high return. Now, typically, if a fund appears or gets plotted on the left-hand side of this particular, x-axis, if it gets plotted here, it typically has a lesser risk, right? On the other hand, if it is getting plotted on the right hand side or extreme right hand side, it typically has the highest risk in the in comparison to its peers, right? Relative basis. This is a relative basis classification. As compared to this fund, this has a higher risk because this is appearing on the right hand side. Now, how do you interpret on the y-axis? So y-axis is annualized return. So if a fund gets plotted at the top, it typically has a higher return as compared to a fund which is getting plotted slightly lower, right? So compared to a quant, for that matter, Canara has a lower return, and that is why Canara is plotted below quant. Right? So this is how you interpret this particular tab, which is risk versus return. Now what we'll do is we'll turn on these labels. What that will do is it will take, rather it will put in the names of the funds right there. And we will see that, okay, if we were to consider last 10 years scenario, so let's say 2013 December onwards, let's see how do these funds catch up with respect to their performances considering risk and return. Right? So a quant flexi cap and a HDFC flexi cap, both of these funds get plotted on the extreme right hand side of this scatter plot, which typically tells that these funds have similar levels of risk, right? However, quant generates a much better return with the same level of risk. On the other hand, HDFC has a slightly lesser return as compared to quant, right? That's why it has gotten plotted slightly lower as compared to quant flexi cap, right? Now, this was for the last 10 years. Now, what we can typically do is understand the beauty of this particular matrix. What we can do is simply change the statistics to, let's say, last 1 year, right? So maybe December 2020, and you click on go, right? So we see here that quant's returns have definitely reduced. It was slightly upper, right? Now they have definitely reduced, but the risk remains predominantly similar as compared to even the last 10 years ago, right? On the other hand, Parag Parikh, it was getting plotted on the left hand side even 10 years before, and it is still getting plotted on the left hand side even now. That typically means this is a fund that has managed to keep its risk levels fairly low as compared to its peers under consideration with a decent return. In this case, in the last 1 year, you can typically see Parag Parikh, in fact, has generated a better return than a quant, right? So if you were to simply choose between a quant and a Parag Parikh, you would probably go ahead with a Parag Parikh because with much lesser levels of risk, it generates a better return as compared to quant. Right? So this analysis can be done on a bird's eye view basis using this risk versus return tab. After that, let's move ahead and understand the drawdowns analysis, which is a tab here itself in the compare section. This is again on a single fund level. I mean, a list of fund levels, right? So we are putting in a start date. Let's consider maybe 2018, or that's typically 5 years. And let's see what are the magnitudes of losses reported by each of these funds. So let's consider 3rd of December, and we click on run. So now we can see if we were to sort each of these funds on the basis of their magnitudes of losses, we can see that HDFC Flexi Cap Fund has reported in a loss of a maximum magnitude, right? There was a loss of 42%. Now, how much time did it take to fall so much? So that is typically 263 days, right? 263 working days, close to a year. 4th of July to 2019 to 23rd of March 2020. That is how long this fund was falling. After falling so much, after 23rd of March 2020, the fund recovered its entire loss of 42% in the next 190 days. And that is why we've termed typically this as the recovery number of days, right? These 190 are number of days taken to recover this loss in entirety. Now, if you were to see what is the recovery date for that loss, you simply click on this icon that you can see beside the name of the fund. And this will give us the loss magnitude, of course, the data that we were seeing here, and as well as with the recovery date. So the 190 days, when did they really elapse from the end date? The exact date was 14th of December 2020. Now, what happened on this date? On this date, the NAV of the fund reached back or reclaimed the level of 704, which was the level when it started actually experiencing a downfall. Right. So this is the drawdowns analysis on a single fund. Now, what you can do is you can simply sort it, right? So let's consider number of days it has taken to recover its worst drawdown. And if we were to sort them on the basis of recovery, we can see that, okay, Nifty 500 as a benchmark takes 165 days to recover its worst loss. On the other hand, we have these 4 funds, Parapare, Quant, UTI, and Canara, which actually recover their worst loss much faster as compared to the benchmark. Right? Alternatively, what you can also do is you can sort them on the basis of their sizes. Right? Simply click on this will get sorted in ascending or descending order. And you can see, okay, HDFC, as we were seeing, it has reported in the highest loss, basically highest magnitude. On the other hand, Parag Parikh has reported a loss of negative 35%, which happens to be its worst drawdown. Okay, so this was on a single fund level. Again, you can replicate this for a portfolio level. All you need to do is load in a portfolio and go to the drawdowns tab, which is the third last tab in the portfolio analytics. Logic again remains the same. The difference is now we are speaking in terms of a portfolio. So this line that you can see, this is arrived at by calculating the weighted average. Basically, it is the NAV of the portfolio, right? This is the price of the portfolio. How has this been arrived at? Weighted average price of each of these weights, basically of each of these funds, multiplied by their respective NAVs. And that is how we've arrived at this portfolio price. The gray periods indicate loss periods and the white portions indicate the recovery periods. That's about the drawdowns analysis. Lastly, let's compare, rather have a look at the rolling returns analysis. And these, again, can be done on individual fund level as well as on a list of funds, and again on a portfolio level as well. To check individual fund rolling analysis, you can simply load in a fund in a new tab, and there's a rolling analysis tab here specifically given for you, right? Wherein you can compare rolling returns analysis over 3 time periods simultaneously. In this case, we are doing a last 5-year analysis, basically from start date of 4th of December 2018. And we are comparing these 3 levels, typically tell you the holding periods under consideration, right? So 260 days, 520 days, and a 780 days, which represent 1 year, 2 year, and 3 year respectively. And now what we are really doing is we are checking what were the rolling returns that were reported by each of this fund over these 3 different time periods. So this blue line signifies, or rather is a line of 260-day period, which is 1 year in terms of holding period, right? So if an investor is invested in this particular fund for any 1 year period in the last 5 years. Okay, why do I say 5 years? Is because look at that. So start date is 2018. So from December 2018 to December 2023, if any particular investor invests in this particular fund for any period of 1 year duration, that is holding period is 260 days, for any 1 year period, then what would be his average returns? So his average returns would be 26.26%. What would be the highest return? So it's 90.73. You can typically hover on this particular peak of this particular graph, and you can see that. Okay, so the investor would have been luckiest if he would have invested in this particular fund exactly 260 days prior to the date that you can see right there. So 22nd of March 2021, exactly 260 days prior, if an investor would have invested, he would have gotten a return of 90.73% from this fund. Okay, now this was for 260 days. You can typically see this for even 520 and 780 by simply either hovering on these particular line charts or reading it from this data type that is tabulated here. The significance of this is tells you how consistent is the return of this particular fund, right? You can even check this on a list of funds, but typically as the holding period increases, you can make out that the lowest that this fund has ever reported is rather goes on reducing, right? With a 1 year holding period, it has a loss of about negative 39%. On the other hand, as the holding period increases to a 520 and a 780 day, this lowest goes on reducing further and actually ultimately turns out to be a positive return, right? So this is the rolling returns on a single fund level. Again, the same thing is replicable on a list of funds as well. The only difference here is we have some more statistics. High and low remains the same. the thing that gets added here is the range, right? So in this case, it tells you the swing that is there between high and low, right? So it can go, in this case, quant flexi cap can go as high as a 140%. It can stoop as low as a -35. So the range is 175%. On the other hand, the percentage positive column that you can see on the extreme right-hand side tells you if you were to consider all of these observations, right? 260-day holding periods, in this case, it's last 10 years. You can say that 77% of the observations, meaning 77% of these returns, 260-day returns, 1-year holding period returns, lie in the positive quadrant, right? Only the balance 30% are in the negative quadrant. That's the significance of this percentage positive. This, again, the rolling returns can be replicated on a portfolio level as well. To check that, simply go to the portfolio section, and there is a dedicated tab for rolling analysis. This the screen will be similar to what you will see for individual fund analytics, but in this case, it will be for a portfolio. You can simultaneously check it for 3 time periods at one single point of time. That's about it from my side for the topic-related webinar. If you have any questions, please go ahead. You can do so. You can really ask your questions by either typing it in the chat box or directly unmuting yourself to speak. Thank you.
Hi, Prajakta.
Yes, please tell me.
Can you explain that the rolling return statistic, like specifically average and volatility? I know we understand.
Yeah, sure. So you want to understand this on a portfolio level or
on a portfolio level?
Portfolio level, okay. So I've loaded in a portfolio. So in this case, what we are seeing is we are running this rolling returns analysis from 2018. So almost last 5.5 years, right? And in this case, we can see that the average return, average rolling return is a 13%. So what that means is if we consider only this blue line, which is a representative of 260-day rolling periods, that means if we consider all 260-day rolling periods, we can see that at there are it is basically rolling for every single data point from 2018, right? For an example, in this case, exact last 260 days return is 57%. Now this rolls for every single day. Now if you take an average of all of this, that comes to an average return, average rolling return of a 13.08%.
This is at portfolio level.
Yes, this is at a portfolio level. This is average rolling return of a portfolio, considering 1 year as the holding period.
But there is no benchmark comparison.
Right. Right. Here, typically here on a portfolio level, for rolling, for that you'll have to go to the compare section to check how has Nifty 500 given in the same time period, right? So in this case, this is the rolling returns of the portfolio alone.
Okay.
Right, and the volatility typically tells you how much different are each of these observations from their means, right? So average rolling returns is a 13.08, right? But it has swung as high as a 57. It has went as low as a -20, right? If you consider how do each of these points deviate from these average rolling returns, that is really indicated by the volatility.
Client
Volatility. Sorry.
Yeah, please carry on.
Yeah, so I was just saying volatility in the rolling returns average return, right? How different are the rolling average returns for the last 260 for any period of 260 days in the last 5 years. That is what is indicated by the volatility number. This is like a double standard deviation, honestly.
Okay. So client purpose, then we have to go to the compare section and see that what is a benchmark return.
Yes. Yeah. So basically, what you can do is, as of now, when you've loaded in this portfolio, let's say, this is a portfolio which has what's a benchmark reference index 2. Let's consider Nifty 500 as a benchmark in this case. And what you will need to do is you put in rolling here. Okay, these are the rolling returns analysis for a portfolio. You simply go to the compare section, clear everything, and simply just keep in Nifty 500. Now we have only one item here, that's a index. You simply go to the rolling analysis, put in the same start and end dates, right? So 260-day rolling window is fine. Start date would be January 2018. 1 second. 1st of Jan 2018. End date, of course, will be 7th of December. And you click on run. Okay, so in this case, we can see the average rolling returns of this particular index, considering, 1 second, this has to be simple. And this is 12.83% average rolling returns of this particular index. On the other hand, the portfolio's average return, 260-day, exactly, is the 13.08%. So this is what you can do right now.
But it cannot be plotted anywhere into this, because in case we have to share with the client to make him understand that whether this portfolio is performing better than benchmark or that, then we have to take a separate sheet from there.
So here, just obviously in terms of Arunabh here, this in terms of performance, in terms of performance was the benchmark. Obviously, the performance page, the tab obviously gives you that. But when it comes to rolling, generally speaking, we've only kind of focused on the portfolio rather than a comparison of the benchmark, because here the purpose is much more about looking at the portfolio returns and how consistent they are. So this rolling tab really gives you a sense of consistency. So, for example, for example, one good takeaway from this tab is that 13.08 is the average expected return over a 260-day period or a 1-year period. The best 12-month return that this portfolio has ever given is almost 60%. The worst one is down 24%. So we hope we don't get that, but that's an idea of how bad things can get. Right. So here, the 13.08 is really an expectation of the 12-month return. And so the purpose of this tab is not so much to compare with the benchmark, but it's just to analyze this security. I mean, you can do this for a single fund or a portfolio. In this case, it's a portfolio. So this gives you a sense of consistency, and ideally, you would kind of show this alongside drawdowns, where you can also show the risk of downside and how bad it is. So again, for example, you can see the size of the drawdown, how quickly they come back. So the rolling tab, the drawdowns tab, and also in the performance tab, the VAR number also gives you a sense of downside. So, let's just go to the performance tab. So here, 18% is the kind of expected downside for 1 year, which has a 5% chance of happening, right? So the rolling tab is much more important to see from the perspective of consistency of return, basically.
Got you. They show the strength of the portfolio.
Yes.
Thank you so much.
Sure.
Yeah. Hello, Prajakta.
Yes, tell me.
You see, we see that rebalancing tab on the top. That fixed weight. There are 4 options here: monthly rescale, quarterly, and annual, and leave invested. Ideally, which one we should pick up?
Sure. So in this, we strongly suggest you should check fixed weights. We have given the other options because people have asked for it. Now, fixed weights means that this is the true historical price of this portfolio without taking into account any kind of compounding, right? So basically what happens is, depending on when you start your portfolio and depending on the path that the returns take, compounding will have an effect. For example, you start at 100, then you go to 120, then you have another 10%, so you'll make 12 instead of 10. But with fixed weights, what we do is we keep returns consistent over time. But if you want to actually see what would have happened if I had got this portfolio on, whatever the start date here is, I can't see, it's just under, on 1st of Jan 2018, and I put it on and I forgot about it. If you want to see that, then there is an option called leave invested. And then the other options are where you can basically, rescale the portfolio at the given intervals, like monthly or annual or quarterly, etc. But ideally for analysis, when you're analyzing portfolios, when you're comparing portfolios, client versus model portfolio, etc., we suggest that you use fixed weights because that's the most fair way of looking at historical portfolio returns across time.
Okay, got it. Now, see, suppose most of the time we have SIP SIP books. In that scenario, what should we do?
See, when you look at
portfolio is getting added every month.
Of course. So the thing is, there are two parts to that return now, because one part is the effect that their SIP is having, they're adding. Now that in some ways is to be honest, random, right? Sometimes you'll get a good entry point, sometimes you won't. So to look at the historical benefit of doing an SIP versus not is kind of pointless because you don't know. It's completely random, right? It's not like every month when we invest, we are definitely getting a better entry point than the middle of the month or anything else, or even a lump sum. So the thing is, when you look at SIP portfolio, it doesn't matter. What matters is what they have on right now. So if, for example, you wanted to get somebody into this portfolio with an SIP, every time they invest, they need to invest in these proportions, the portfolio weights, every month in these funds. Right? So your portfolio backtest from a portfolio analysis perspective will remain the same whether you're doing lump sum or SIP, because that is a completely separate return stream. I mean, I don't think that lump sum versus SIP should be looked at as a strategy, simply because, if I'm sitting here today and I have 1 crore in the bank, should I do a SIP or should I do lump sum? Now, mathematically speaking, if I did a lump sum and 10 years later it has gone up, right? Obviously, that return is going to be more than if I do SIP over the next 3 years, because the price is going up. My average price is still going to be higher than whatever my lump sum price was. So if I have the money now, it makes no sense to think that doing an SIP is going to increase my return. The only way doing an SIP is going to increase my return versus a lump sum, if I have the money now, is if the price goes down and keeps going down while I'm doing my SIP and then suddenly starts to go up. So SIP will always use you money. So the only reason to do an SIP is if you don't have the money today, to take a percentage of your salary and put it in. That makes sense because I don't have my entire year's salary today. I will get it every month. So that is a money management strategy. But from a perspective of investment, there is no reason to delay your investment. The only reason to delay your investment would be that you think it's going to fall. In which case, there's questions about whether you do it or not. So obviously these. So when we look at portfolios and rebalancing them, that's fine. But when we look at portfolios and putting them through SIPs, it's the same thing. You just look at the latest portfolio and you backtest it to see whether or not it's a good thing to invest in or not.
Okay. So ideally, fixed weightage is the first preference, followed by leave invested.
Absolutely.
Thank you.
Thank you. Any other questions? Please let us know. There's nothing else, Prajakta, we can close for today.
Yes, sir. So thank you everyone for joining in. You can have a look at our past webinar recordings on our YouTube channel. So there is a dedicated playlist that is created for all the past webinar recordings. You can simply visit our YouTube channel from the software link. So we've already given a link to our YouTube channel right there. There's a playlist that is created for webinars. Already 91 odd videos already uploaded. You can definitely have a look at those. So thank you everyone for joining in. We'll come up again next week with another exciting topic. Till then, stay tuned and have a great weekend ahead. Thank you.